Welcome back to Investing Talk Podcast.
Today we're looking at Nebius Group.
As usual, before we start, subscribe, like, and comment to this video to support the show.
Yeah.
And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Okay, so Nebius Group. This is a story that seems to be all about just explosive growth.
It is. It really is. I mean, when you look at Nebius, you have to understand it's a pure play AI infrastructure provider.
Right.
And its core business is in what you can only describe as hypergrowth. It's a key supplier in a market that is just, well, it's fundamentally supply constrained.
And the numbers, they really back that up, don't they? I'm looking at the latest figures here. Q3 2025 revenue was $146 million.
Which on its own is a decent number, but the growth rate is the story.
It's a jaw-dropping 355% year over year.
Exactly. And even that doesn't tell the whole story.
No, because if you drill down into their core infrastructure segment, the part that's nearly 90% of their total revenue, that grew even faster, 400% year over year.
That kind of acceleration it's the defining feature here. And it brings us to this really core bullish point that management has been hammering home.
Which is?
Their revenue growth was limited only by the speed at which they could physically bring new capacity online.
Think about that for a second. That's incredible.
It is. They're not out there struggling to find customers. They're struggling to build data centers and get their hands on GPUs fast enough to meet the demand they already have.
So it's not a sales problem, it's a logistics problem.
Precisely. And that whole supply-constrained view underpins these massive expectations they've set.
You're talking about the annualized revenue run rate target, the ARR.
Yeah, they're targeting between $7 and $9 billion by the end of 2026.
Wow. Okay, so from $146 million in a quarter to an ARR of, high single-digit billions.
In just over a year.
Yeah.
It's a monumental goal. It's going to require near-flawless execution and a huge, huge amount of capital.
But their confidence here, it isn't based on hope, right? It's contractual.
That's the bedrock. You're absolutely right. Nebius has locked in these multi-billion-dollar, multi-year AI infrastructure contracts.
With some of the biggest names out there.
The biggest. We're talking about massive long-term commitments from Microsoft and Meta.
And what's the total value on those?
Our sources are indicating total commitments valued at over $20 billion.
$20 billion?
Yeah, across multi-year terms. I mean, for a company this size, that provides a level of forward revenue visibility that most tech companies can only dream of.
So it basically de-risks a huge part of their build-out plans.
It does, and that visibility is tied directly to the tech they're supplying. Their AI Cloud 3.1 platform is right on the cutting edge.
This is the NVIDIA Blackwell Ultra integration, right?
Exactly. They're selling the most powerful digital pickaxes on the market right now.
And that matters because the performance jump is huge.
It's absolutely key. We know the Blackwell architecture offers these huge performance leaps. Sometimes 40 to 50% better performance on certain large language model training tasks than the older Hopper generation.
And for a company like Meta or Microsoft, that's not just a nice to have.
No, when you're training models with trillions of parameters, that efficiency difference translates directly into billions of dollars saved.
Okay, let's talk about the competitive landscape. This is where I see a lot of the criticism.
The no moat argument.
Exactly. People say they're just a commodity GPU provider. What's stopping an AWS or a Google from just crushing them with superior scale and cheaper capacity?
It's an essential question, and you have to distinguish between a traditional, intellectual property moat and what we could call a capacity and integration moat.
A capacity and integration moat. Okay, unpack that for me.
Well, first, capacity itself is the moat. Right now, there isn't enough high-end AI compute capacity in the world, period.
And Nebius got in early.
They secured a huge allocation of Blackwell capacity early, so they're one of the few places these giants can go to get what they need right now.
Okay, so that's the capacity piece. What about integration?
The integration is incredibly deep. Once Microsoft starts training its giant proprietary models on Nebius's specific hardware stack.
Their architecture.
Yeah, tearing that out and moving it somewhere else becomes prohibitively expensive. It's risky. It's time-consuming.
So the switching cost isn't just about moving some servers around.
No, not at all. You'd be disrupting complex, ongoing, multi-billion-dollar AI development pipelines.
That makes a lot of sense.
And this all links back to the strategy. Nebius is basically acting as a strategic utility supplier for these guys. Microsoft and Meta get to outsource a huge chunk of their immediate capital expenditure risk.
They get the capacity without having to sink $5 billion into a new data center themselves.
Exactly. And that locks in multi-year demand for Nebius, making the moat extremely defensible for the foreseeable future.
All right, so that's a strong argument. But let's flip the coin. We have to talk about the financial side of this.
Yeah.
The capital intensity.
The big one.
Capturing this market means spending just a staggering amount of money.
It does. This is the calculated risk they're taking. They've raised their 2025 CapEx guidance significantly. They're now targeting a monumental $5 billion.
$5 billion. And that's all going into data centers and GPUs.
All of it. It shows they have zero hesitation about seizing market share.
And the immediate result of that, of course, is losses.
Big ones.
The company is deeply free cash flow negative. I think the net loss was $119.6 million in Q3. That's a scary number for a lot of investors.
It absolutely is, and you can't just dismiss it. But, again, context is everything. This is a deliberate strategic choice.
Burn cash now to own the market later.
That's the play, and they have the runway to do it. Nebius has a strong balance sheet, a substantial net cash position, over $1.5 billion in net cash.
So they have the liquidity to fund this without hitting a wall.
Right. And there are positive signs buried in the numbers, too.
You mean in the core infrastructure segment?
Exactly. That segment, the one driving 90% of the revenue, it's already achieved an adjusted EBITDA margin of nearly 19%.
And that's expanding, right? Quarter over quarter.
It is, which signals powerful underlying operating leverage. Once those massive fixed costs are absorbed by all that revenue from the new contracts,
The profitability should inflect pretty quickly.
that's the expectation. Management thinks the group will be slightly adjusted EBITDA positive by the end of 2025. That would be a huge milestone.
Okay, so they're spending $5 billion, but they need a disciplined way to fund it. How are they raising the capital without just, cratering the stock with a massive secondary offering?
They're using something called an at-the-market equity program, or ATM.
Okay.
It's a very smart, flexible way to do it. Instead of announcing one huge offering that tanks the price, they can issue up to 25 million shares gradually, surgically.
So they can sell into strength, basically.
Exactly. It lets them tap capital when the market price is good and when they actually need the cash for CapEx. It avoids that huge dilution shock and matches the fundraising to the construction schedule.
Smart. So the company's making this huge long-term bet. How has the market, which is usually so focused on the short term, been reacting to all this?
With extreme volatility, which, that's what you'd expect. The stock has been a massive winner this year, up over 200%.
But it's been a bumpy ride.
Oh, yeah. We saw a significant 30% pullback from the highs back in October. The market is just constantly torn between the excitement of that $9 billion run rate and the fear of the $5 billion CapEx.
And where are we now, technically speaking?
The price is consolidating now, finding a range, which is healthy after a huge move up. Analysts are watching that low to mid $80 area as a pretty strong support zone.
But there are still some headwinds, some sentiment risks holding it back.
For sure. There are two main things creating near-term pressure. First, insider sales. We've seen multiple sales from key executives, including Arkady Veloz.
That never looks good, even if it's planned.
Right. And while some are framed as routine sell-to-cover tax transactions, it still puts supply on the market and makes investors question insider conviction.
And what's the second thing?
Short interest. It's really, really high. We're talking about 15.5% of the public float.
15.5%. Wow. What's the average for their peers?
Much lower, closer to 5.6%.
So the bears are making a huge bet that this growth story is going to fail.
They are. But that creates a tactical opportunity.
A short squeeze.
A big one. High short interest is just fuel for a squeeze. If their next earnings report validates that 2026 growth story, those shorts will be forced to cover. And that buying pressure could really accelerate a move to the upside.
Which brings us to catalysts.
Yeah.
What is the single most important event on the calendar for this stock?
It's the Q4 2025 earnings release. That should be late January or early February 2026. And the market will be laser-focused on one thing.
The 2026 guidance.
Management has to reconfirm that $7 to $9 billion annualized revenue guidance. That figure is the barometer for the stock.
And if they do, the focus shifts back to execution risk. Let's dig into the two biggest risks here. First, that 7 to 9x expansion in 1 year. How can they possibly pull that off?
It's the highest risk, no question. It depends on timely data center builds, getting the GPUs from NVIDIA, and then deploying it all flawlessly for Microsoft and Meta. The risk is immense.
So what are they doing to mitigate that?
Well, they're using modular data center designs to speed things up. They have pre-negotiated supply pipelines for the chips, and crucially, the contracts are already signed. They're building to satisfy immediate paying demand.
Like any slip up.
Any delay in construction or supply could push revenue out and disappoint a very expectant market.
Okay, and the second major risk, customer concentration.
Yes, they're relying so heavily on just two companies, Microsoft and Meta.
Which is a huge vulnerability. If one of those partners shifts strategy or cuts their own AI spending.
Nebius is left holding the bag. A 30% cut in Meta's AI budget would significantly impact Nebius's entire 2026 revenue ramp.
So why is the market looking past that for now?
Because of the contractual visibility. These are multi-year deals that are hard to break. And the underlying demand for AI compute isn't slowing down, it's accelerating. These giants need all the capacity they can get their hands on right now.
So to pull it all together, Nebius Group is basically selling the picks and shovels for the biggest technology gold rush in a generation.
But they're doing it at the highest possible cost and risk level. Absolutely. For you, the listener, this is a high beta, high stakes way to play the AI infrastructure boom.
And it requires a long-term view.
A multi-year horizon, minimum. You're essentially underwriting the 2026 story today. You have to be patient enough to let that massive $5 billion CapEx spend translate into future free cash flow. It's a deferred gratification play for sure.
A fascinating look at the economics of this AI race.
And here's a final thought for you to mull over. If Nebius actually pulls this off, if they hit that $9 billion run rate, they will have proven that specialized, outsourced AI infrastructure can be a high-margin utility.
So what's the implication of that?
Well, does that mean the traditional hyperscalers like Amazon Web Services might be forced to acquire a company like Nebius just to catch up on critical Blackwell capacity in the next 18 months?
That's a whole other level to consider. An acquisition target.
Make sure you subscribe to the podcast so you don't miss our next analysis.